Welcome to the deep dive. You're with us because, well, you need to get up to speed on complicated stuff quickly.
And today we're really diving into something specific.
Yeah, something that sounds maybe a bit technical, but it's actually fundamental for understanding big global companies. We're talking about auditing group financial statements.
Right. Think about those massive multinational corporations you read about. Their finances aren't just one single picture.
No.
It's like a web, isn't it?
Yeah.
You've got the main parent company, sure, but then subsidiaries all over the place. Maybe factories here, R&D labs there, shops somewhere else entirely.
Different countries, different rules.
Exactly. And group financial statements.
Yeah.
That's the attempt to pull it all together into one consolidated view.
The big picture. Parent company plus all the subsidiaries. And auditing that, well, it's a whole different ballgame compared to auditing, say, a single local business.
Oh, completely different. The complexity shoots right up. And, there's a specific set of guidelines for this ISA 600.
ISA 600, Special Considerations Audits of Group Financial Statements. That's our main source material today.
That's the one. It's basically the auditor's roadmap for navigating these complex group structures.
So our mission for this deep dive is to unpack ISA 600, pull out the really key things you need to grasp. We want to, make it make sense, maybe trigger a few aha moments without getting totally lost in the technical weeds.
Sounds good. So where should we start? The basics.
Yeah, let's start right at the beginning. What's ISA 600 actually for? What's its main purpose and scope?
Okay, so fundamentally, ISA 600 gives auditors specific instructions for when they're auditing these group financial statements. It gets particularly important when other auditors are involved.
Other auditors, you mean like auditors for the subsidiaries?
Precisely. They're called component auditors. So if you have a big group, the main auditor, the group auditor, might rely on the work done by these component auditors who are closer to the ground, so to speak, in different locations or business units.
Okay, that makes sense. Like if a UK company owns a factory in Brazil.
Exactly. A Brazilian firm might audit that factory. They're the component auditor. ISA 600 explains how the main UK group auditor should interact with them, what they need to check, how they use that work.
Got it. And the end goal.
The end goal, the standard is very clear on this, is for the group auditor, the main firm, to be able to form a solid, evidence-based opinion on the entire set of group financial statements. It's their name on the final report.
Right. They take responsibility for the whole thing, even the parts audited by others.
They do. And just worth noting, this isn't some old standard gathering dust. This revised ISA 600 kicked in for audits of financial periods starting on or after December 15th, 2023. So it's very current.
Good point. Okay, so to really understand how this works, we probably need some definitions. Like, what are the absolute key terms in ISA 600 we need to know?
Yeah, definitions are crucial here. Paragraph 14 lays them out. First, obviously, group financial statements. That's the combined report for the parent and all its components.
The whole consolidated package.
Yep. Then you have a component. That's any part of the group, a subsidiary, a division, whatever, whose financial info is included in those group statements.
Like our Brazilian factory example.
Exactly like the Brazilian factory.
Yeah.
And the firm auditing that factory is the component auditor.
Okay. Component auditor. Got it.
Then, moving up the chain, you have the group audit engagement partner. This is the key individual, the lead partner at the main audit firm who has the ultimate sign-off.
The buck stops with them.
Pretty much.
Yeah.
And group auditor usually refers to that partner and their whole team working on the group audit.
Okay. Structure seems clear. What about those other terms you mentioned earlier? Aggregation risk.
Ah, yes. Aggregation risk.
Acro-
It's the risk that small errors or misstatements in several different components, maybe none of them material on their own.
Could add up.
Exactly. They could add up across the whole group and actually become material. A significant problem when you look at the consolidated financials, like lots of little streams potentially forming a big river of misstatement.
I see. And component performance materiality, how does that fit in?
Right. So the group auditor sets an overall materiality level for the group financial statements. But then for individual components, they'll often set a lower level called component performance materiality.
Lower. Why lower?
It's like building in a safety buffer. By setting a tighter tolerance for errors of each component, you reduce the chance that those small, individually acceptable errors will aggregate up and breach the overall group materiality level.
Okay, that makes sense. You're being stricter with the parts to protect the whole. Got it. So who's really running the show here? You mentioned the group engagement partner.
Yeah, the group engagement partner is absolutely central. The standard paragraphs 11 and 16, I think, makes it crystal clear. They are ultimately responsible for the direction, supervision, performance, and overall quality of the group audit. Full stop.
So even with component auditors doing work, the main partner can't just, like, delegate and forget.
Absolutely not. They own it.
Yeah.
Their responsibilities are pretty broad. First, obviously, leading and directing the whole group audit team, keeping everyone on the same page.
Coordination is key, I imagine.
Huge. Second, they have to set the right tone, foster professional skepticism. That means encouraging a questioning mindset, especially when looking at the work coming back from component auditors, not just taking it at face value.
That sounds important. Trust but verify.
Sort of, yeah. But more actively skeptical, paragraphs 17, 18, and 9 talk about this, like a conductor making sure every section is not just playing, but playing correctly and critically listening.
Especially if those component auditors are in different countries, maybe different cultures.
That adds another layer for sure. And thirdly, a big one, the group engagement partner has to decide whether their firm should even take on or continue the audit engagement.
Before they even start.
Yeah. They need to assess, do we actually have the skills, the resources, the time, the access, the geographical reach maybe, to do this complex group audit properly? It's a crucial upfront decision.
Wow, okay, so big responsibilities. Assuming they accept the engagement, what's next? Understanding the beast they're auditing.
You nailed it. Getting a deep understanding of the group itself is paramount. Paragraph 30 really hammers this home. The group auditor needs to understand the group's structure, all the components, how they fit together.
Not just the org chart, I guess.
No, much deeper. What does each component actually do? How significant is it financially? What's the business environment like where it operates? What are the specific risks?
And this understanding must include things like internal controls,
Yeah.
right, across the whole group.
Absolutely. How do controls work at the component level? How do they feed into the group's overall financial reporting? What about the consolidation process itself? How do they actually combine all the numbers from the components?
Because errors there could mess up the whole picture.
For sure. And don't forget, the IT systems involved in that consolidation need to understand those too. Paragraph 30 covers all that. It's like needing to know the ingredients and the recipe.
Makes sense. And geography plays a role, too.
Definitely. Paragraph 93 mentions considering the different locations, different regulations, maybe different accounting standards needing reconciliation, different economic conditions. It all adds complexity.
Auditing a company just in, say, Ohio is very different from auditing one with bits in Ohio, Germany, and Singapore.
Totally different challenge. Okay, so once they've got this, hopefully, deep understanding, the next logical step is identifying where things might go wrong, assessing the risks.
Right. Risks of material misstatement. With all these moving parts in a group, seems like there'd be more places for risks to hide.
Potentially, yes. Paragraph 33 says the group auditor has to identify and assess these risks, not just for the group as a whole, but also down at the component level. What could go wrong within that Brazilian factory, and how could that impact the group's numbers?
And this is where component performance materiality comes back in.
Exactly. That lower threshold we talked about helps focus the risk assessment at the component level. Paragraphs 35 and 116 link this back to managing that aggregation risk, making sure you catch potentially problematic things early at the component level.
Setting those tripwires, like we said.
Good analogy, yeah. And ISA 600 actually gives examples of things that tend to increase risk in group audits. Appendix 3 has a list.
Oh, like what?
Things like really complex group structures, maybe with lots of holding companies or special purpose entities, significant transactions between components, especially if they're not clearly at market rates.
Ah, intercompany dealings.
Yeah, those need scrutiny. Also having components in heavily regulated industries or weaknesses in group-wide controls, or even just having very decentralized accounting functions where policies might not be applied consistently. All red flags for higher risk.
Okay, that paints a clearer picture of the potential pitfalls. Now let's go back to those component auditors. You said they get involved often due to size or location?
Right. If a component is financially significant or just too far away for the main group audit team to handle efficiently, they'll often engage a component auditor.
Makes practical sense. But the group auditor can't just blindly trust them, right?
Absolutely not. This is critical. Paragraphs 23, 25, and then 62 to 64 really stress this. The group auditor must evaluate the component auditor.
Evaluate them on what?
Their professional competence, do they know what they're doing? Their adherence to ethical requirements, especially independence, are they objective? Do they understand the relevant standards? The group auditor needs to get comfortable with them.
Like vetting a subcontractor for a critical job.
Exactly. Yeah. Because remember, the group partner is signing off based partly on their work. So, assuming they're comfortable, how does the communication work? Is it just, here's the report, thanks?
I imagine it needs to be more involved than that.
Much more. Paragraphs 24, 29, 77, 78 talk about the necessary communication. It has to be a two-way street and ongoing. The group auditor needs to clearly tell the component auditor what work needs doing, the scope, the deadlines, the key risks they see.
Setting the expectation.
Yes. And, crucially, the component auditor needs to report back their findings, any limitations they faced, any potential issues, any significant risks they identified. It's a dialogue.
So continuous updates, not just a final handoff.
Ideally, yes.
Yeah.
And interestingly, paragraph 24 also says that the group auditor might decide they need to do some work at the component themselves, even if there is a component auditor.
Really? What?
Maybe there's a super high-risk area they want to look at directly, or maybe they want to review the component auditor's work papers on site. Or perhaps they have some concerns and want to do some procedures themselves to get comfortable. They don't just have to rely. They can get involved directly.
So they stay actively engaged. Okay, risks identified, component auditors potentially involved and evaluated, communication lines open. What's the next big phase? Responding to those risks.
Precisely. Now it's about action. Paragraph 37 says the group auditor designs and performs further audit procedures, specifically to address those risks they identified earlier, both at the group level and the component level.
What might that look like in practice?
Well, at the group level, it could mean really detailed testing of the consolidation process itself, checking the adjustments, the eliminations of intercompany profits, things like that, reviewing group-wide controls.
Okay, and at the component level?
It could involve telling the component auditor exactly which procedures to perform on specific high-risk account balances. Or the group auditor might perform their own analytical procedures on the data submitted by components, looking for unexpected variations or trends. It's all about tailoring the response to the risk.
A targeted approach.
Yeah.
Makes sense. So after all this work is done by the group team, by the component auditors, how does the group auditor pull it all together? How do they know if they have enough evidence?
That's the evaluation stage, covered in paragraph 51. It's critical. They have to step back and assess all the evidence gathered from their own work from the component auditors and judge if it's sufficient and appropriate.
Sufficient meaning enough quantity, appropriate meaning relevant and reliable.
You got it. Do we have enough good quality evidence to support our final opinion on the group financial statements? It's like a prosecutor deciding if they have enough evidence to go to trial.
What if they don't? What if they hit roadblocks? Maybe a component auditor couldn't get certain information.
Yeah, that can happen. Paragraph 21 and Appendix 1 discuss these limitations on the scope of the audit. Maybe management restricted access, or records were lost, or the component auditor just couldn't complete certain key procedures.
And if that happens?
If the limitation is significant enough that the group auditor feels they can't form a proper opinion on the financials, they might have to modify their audit report.
Ah, okay. Which brings us nicely to the final output, the auditor's report itself. How does the fact that component auditors were involved show up there?
Good question. Paragraph 53 and Appendix 1 explain that the report on the group financial statements will typically mention that the audit involved component auditors for certain parts of the group. It's about transparency for the readers.
So users know it wasn't just one team doing everything.
Correct. And tying back to what we just said, if there were those scope limitations, or if the auditor did find material misstatements that weren't corrected, the opinion itself might be modified.
Not just a clean bill of health.
Right. It could be a qualified opinion, everything's okay, except for this issue, or an adverse opinion, these statements are not fairly presented, or even a disclaimer, we couldn't gather enough evidence to form any opinion. Appendix 1 gives examples of how this wording might look.
So the report can tell a complex story. Now, you mentioned Appendix 3 earlier with risk examples, complex structures, intercompany deals. Can you give us maybe one more concrete example from there?
Sure. Another good one is components operating in highly regulated industries. Think banking, insurance, pharmaceuticals. These industries often have very specific, complex accounting rules and regulatory reporting requirements. This inherently increases the risk of material misstatement, either through error or non-compliance. So the auditor needs specific expertise, either on the group team or via the component auditor, to properly audit those components.
That really drives home how the nature of the component's business can create unique challenges for the group audit. It's not just about adding up numbers.
Not at all. It underscores that auditing group financials is, well, it's a specialized skill. The complexity, the different jurisdictions relying on other teams. It really demands a careful, coordinated approach, guided by IS 600.
And that central role of the group engagement partner seems absolutely critical throughout this whole process. They're the anchor.
Definitely the anchor. They're steering the ship, making sure everything holds together to deliver a quality audit. Understanding these dynamics isn't just for auditors either.
Right. Investors, regulators, anyone relying on those big company financials needs to appreciate the complexities involved in assuring them.
It's fundamental to trust in the financial reporting of these huge, often global entities.
This has been super insightful, really clarifies the unique challenges, and it does make you wonder, with businesses getting seemingly more global, more complex all the time,
Hmm.
how is that increasing complexity going to keep challenging the audit process in the future? What new hurdles will auditors and standards like ISS 600 face down the road?
That's a great question to ponder. How do standards and practices keep evolving to ensure audits remain effective in an ever more intricate global economy? It's definitely food for thought.
Indeed, it is. Well, thanks for joining us on this deep dive into auditing group financial statements. We hope it's given you a clearer picture of the special considerations involved.
Hope it was helpful.
Join us next time for another deep dive into a complex topic.